topic is, of course, very close to both our hearts. It is the changing audit landscape, learning from regulatory review of NFRA and QRB. Of course, my role is going to be in the first part, giving the overview of the changing audit landscape, and Govind will go into the detailed, the experience of the regulatory reviews which are happening at the NFRA and QRB, etc. So that's the way we have broken it up. Friends, the auditing, what we have been doing, I think many of us are seniors in this audience. I have been doing it for almost 35, 37 years. And it has changed completely. And especially, I think, in this millennium, post 2001, I think it has changed substantially. And it is keeping on changing at a very, very rapid pace. And that's why this topic is very important for all the practitioners, whether they're large firms, mid-sized firms, or smaller firms. I think we need to understand what this change is. We need to accept the change, and we need to implement the change in audit practices and the methodologies which we are, using. Then and only then, I think we will be successful. Otherwise, I think the firms who are not going to change, the individuals or the professionals who are not going to change, I think are going to have a very, very tough and a challenging time. Coming back again, in my view, the major challenge which I think the audit profession had, if I can say so, was the year in which the tax audit was introduced, way back in 1985, where I think many of the professionals who were on the tax side entered the audit space just so that the clients are not lost. And what happened was their background of audit was lost. They were not practicing audit for many years. They were more practicing tax, and they started again doing audits after a gap of many years. So that was one area where I think there was a challenge. Apart from that, many firms even now who are in audit and who have been there for, I would say, decades, I think either we are not changing the way things are changing across the world, or we're changing at a very slow pace. I think the world is changing very fast. And I think that's the reason why this topic is there today, just to know what is happening and, gear up to the change. And of course, whilst I appreciate that the reviews of NFRA are taking very, very extreme, I would say, interpretations of certain matters. But having said that, that's a reality. And I think we'll have to live with it for some time till the time it changes and gear, ourselves up. One other area in audit, what is happening, friends, is whether it's a business failure, whether it's a governance failure, I think all the blame is being put on the auditors now. And whether, apart from the fact that there's always been expectation gaps and to some extent delivery gaps for some of us, but even the expectation gaps are sort of hurting the profession. With this, I think very, very, I would say, helicopter view, I would, like to get into my presentation. Yeah, let's get into the next slide. Let's first start on a very, very light note. Friends, you would have heard this many times, but I would won't mind repeating in the accountant's report. We have audited the balance sheet, and here is our report. The cash is overstated, the cashier being short, the customers receivable are very much past due. If there are any good ones that there are very, very few. The inventories are out of date and practically junk, and the method of the pricing is very largely bunk. According to our figures, the enterprise is record, but subject to these comments, the balance sheet is correct. Now, friends, this is what I think has come in 1951 edition of the accounting review, but the feedback is this is prevalent from 1930s. And even then, this is true. I think the amount of but again, as we say, the way audit is changing, earlier we could say a lot of things and say subject to the true and fair view. Now we can't say subject to the material modifications, or as we earlier calling it, qualifications. I think we have to either disclaim or give a not true and fair view. So that's where it is. Next. Yeah, you can continue. I think the whole, even as we speak, before, I think when we decided the topic, this issue was not there. The absolute latest issue of the Silicon Valley Bank, which has gone bankrupt suddenly. And again, I think what has happened here is the immediate response was, what were the auditors doing? Here the fact of the matter is there has been no accounting, I would say, challenge. It was more a business decision of investing short-term deposits into long-term maturity government securities. So it was more an asset liability mismatch and more of a risk management failure. But the blame was given to the auditors. I would say the auditors have given the true and fair view. I don't know whether the scope of asset liability management or the risk management was, definitely from a going concern perspective, they might have had to look at it. But I don't think they would have also anticipated a run on the deposit the way it is. No bank, nobody in the world can. So I'm not justifying. This is all prima facie view I'm giving, subject to all further investigation, then which will come out. But blaming the auditor again, this is given a case in point where, irrespective of business failure, irrespective of risk management failure, irrespective of failure of the, may not be a fault of the auditor, but the first to be blamed was the auditor. So let's, and not the perpetrators, whether they are the risk, people or the board or the, whoever was managing the bank. Next. I think if I go back, though I have been requested to talk for 10 years, last 10 years, what's happening, I think the whole starting point of this is Enron. And I think as all of us know, that was the largest bankruptcy in US history in 2001 till that time. Of course, later on, there were larger bankruptcies, and which made one of the audit firms just go disappear, Arthur Andersen, as we know. And this is what led to the first, I would say, regulatory intervention on the audit profession, if I can say, whether it's a Sarbanes-Oxley Act, the SOX as we commonly call it, or the PCOB was started at that point of time. So this was what happened in the US. And we can go to the next slide. What happened in India, friends, at that time was in 2001, the government set up a Naresh Chandra committee, an expert committee, which looked into whether we need independent. Generally, what happens, whatever happens in the world, India also tries to emulate. So this committee was set up and they reviewed. And thanks to the representations of the institute and some commitments that the institute did, it was decided that a separate regulator, ICA is a regulator and separate regulator is not required. This I'm seeing in 2001, 2002. And arising out those discussions, the institute set up the peer review board in March of 2002 and the financial reporting review board in the July of 2002. So peer review board was to look at the audit quality of the firms, and financial report review board was to look at the financial statements, especially of the listed companies. And both these boards have done a wonderful job in the last, almost 21 years of the existence. They have peer review board has upgraded the quality of the, audits in the firms. And I can myself, say as a firm, our first peer review was done by our Honorable Past President Mukund Chindle. And a lot of, I'm saying this is inputs we got from him, and it helped us. And we have gone through a number of reviews after that. And all the reviews have successfully helped us to, keep on upping our level of, I would say, the documentation. We all do good audits, but if the documentation is not good, I think it's not good enough. So this was, friends, in 2002. And then the CA Act got amended in 2006. Possibly at that time, the parliament felt that this was not enough because it was very nascent. It had hardly kicked off, these two, boards. And the CA Act came out with the Quality Review Board. And mind you here, this Quality Review Board was under ICAI, but 6 members of the Quality Review Board from the government, 5 ICAI nominees, and the chairman was from the government. So this was supposed to bring in more independence from the institute. And again, the problem was, though this QRB was set up in 2006 under the Act, the amendment to the CA Act, but this became functional, if my memory serves me right, somewhere in 2009-10 only, 2009 or so. It took 2-3 years to kick off the government to appoint the nominees, etc. It typically happens, with these things. So that's the, origin. And I think somewhere after 2-3 years, it started functioning, somewhere in 8-9 or whatever. Yeah, please carry on. Next slide, please. Next. So around about time, the QRB was just nascent or started functioning, and even the FRRB and the PRB, I think, was just few years into the, I would say, fray. Satyam broke out, and all of us know what happened with Satyam. A 7,000 crore accounting fraud. The Indian arm of the auditors were fined about $6 million by the Securities Exchange Commission of US. The auditors were barred by the SEBI for 2 years in India, and the auditors also withdrew their report. First time, I think, in the Indian history, I think in a large entity, we saw a withdrawal of an audit report. So this was the background. Next. Friends, this led to the 2009, the Companies Amendment Bill was introduced, though the Act came in 2013, and the Companies Bill went through 2-3 iteration. I think the 2009 one was withdrawn, lapsed, I think, in the Parliament. Then again, it was reintroduced in 2010. And this, if I can say, this new Companies Act was a reaction to Satyam. Almost, majority of the provisions were just to see how things like Satyam don't happen. And in that particular thing, in the drafting stage, if my memory serves me right, the topmost governance provisions of the world were, sort of copied, whether it's Australia, Canada, US, UK. And this was supposed to be, though our Indian ground realities were different, but from a governance perspective, this was the topmost, act. And one thing to note here, substantial provisions on financial reporting and depreciation, etc., and auditors. But very importantly, the NFRA provision, section 132, was introduced somewhere later in the bill, somewhere in 2012. I don't remember the exact date, without any public debate. Most of the other provisions of the Companies Act had huge debates. There are different committees, JJ Irani committee, this committee, that committee. So the enough debate of a lot of sections. Whether those debates, whether the Ministry of Corporate Affairs, the government accepted or not is a different matter, but there were debates. But in case of NFRA, there was no debate, no discussion, with the whether with the profession or with the outside bodies. And just to give a case in point, this law was a reaction of Satyam, and there was so much mindset of criminalization. So there were a lot of criminal provisions which were brought in, criminal punishment which was brought in. And I think after 3-4 years, somewhere in 2017, 18, 19, a committee was set up where two of our honorable past presidents, Mr. Amarjit Chopra and Mr. Ramaswamy, were there. And almost, I think, 50-60 sections they decriminalized. What I'm trying to say, friends, is I think the government, the regulator, everybody has to understand that till the time human greed is going to be there, there'll be frauds. I think what we need to have is maybe a very quick, swift mechanism for punishment. But we cannot have laws just because one fraud has happened. See, we cannot avoid fraud just by legislation. It will be how the legislation is implemented. Earlier, in the earlier Companies Act, also there were enough and more provisions under which things could have been, the people could have been prosecuted. So anything happening and law changing or whatever, I think that's the only request which I have to our honorable government, which we have been keeping on saying. And when we speak about fraud, I think when we come to discuss about NFRA, I'll speak something more about that. Next slide, please. And this is the, Companies Act brought in the internal control on financial reporting. And not only on internal controls of the company, auditor had to certify, not only the financial reporting, but all the controls. And here also, again, friends, if you remember, it was the auditors had to confirm without the management confirming it. And then it was brought for the management also, and ours got restricted to financial reporting. I'm not going to go into each slide. Please go ahead. So much in detail. Just to give, my job is to give you a background what has happened. And then came the CARO amendment in 2015. The first one was simplification from the erstwhile 21 clauses. Only it came down to 12 clauses. But within a year, this 12 clauses became 16. Again, all this is history. All of us know. I will not speak more. Please, let's go ahead. And the same Companies Act brought in auditors rotation. Here I want to speak a little bit, friends, is at that time, let me be very honest, when the Companies Act came, I was personally against the rotation. I felt it was not required, but let me tell you, post the rotation and come in, I believe from a governance perspective, rotation is good, a fresh set of eyes coming in. Otherwise, there's, more complacency, more, I would say, camaraderie, which creeps in after a long stint. So this is what has happened. And I think one very good impact of this rotation was, I think we saw some very good, after a new auditor was appointed, there were quite a spate of resignations which happened. Within a year or 2 years of the rotation, I think this was effective 2017-18, and post that maybe 18-19, because the risk which one firm was taking, the new incumbent firm was not willing to take the same risk as far as certain matters were concerned. And then that forced SEBI to bring out with the guidelines on auditors' resignation. Then it was brought into the MCA also in the rules that if auditor resigns, what all has to be done. And this is what has happened. Let's go further. Next slide, please. And the same Companies Act, no, this is not the Companies Act of 2013. I think when the new government came in 2014, in the first budget speech, Arun Jaitley ji, our Honorable Arun Jaitley ji, as a finance minister, announced that Ind AS will be, implemented. And this was ready by 2011. We were supposed to be implementing it from 1st April 2011. And the institute was ready. It should have done a wonderful work in 2010-11 to bring in almost 35-36 standards that time. to review it and bring it up, and it was almost ready, but it got postponed. And when the new government came, they sort of implemented. And this, are IFRS-based standards, and these were made mandatory from 1670 most companies, and for NBFCs, I think from 1718. And these are, sort of based on IFRS. So these are, comparable internationally, transparent, and largely based on the fair value approach. And at the same time, the Ind AS related financial statements, Schedule 3, the Division 2 was introduced. And still the banking and the insurance companies are out of Ind AS or the IFRS-based accounting standards. And then we saw the new standards like revenue recognition coming in, Ind AS 115, or the leases, Ind AS 116. This was again game changing. The leasing, the way we accounting lease rent, and the way sort of the new under the new leasing, this thing, the whole balance sheet item, the right to use asset and the liabilities getting created is changing the whole way the accounts are looked at in case of a lease. And the Division 3 was introduced for NBFCs in 2019. And these are the impact. This is only the non-financial services impact, which is there on the right-hand side. The maximum impact has been when it was implemented to the NBFCs, a huge impact on the ECL provisioning which companies had. Luckily, most of them adjusted it out of the opening reserves, the expected credit loss, because they had to start providing from day one of the asset being lent. And the huge this thing, but most of it got adjusted out of the opening reserves. But substantial, I would say, impact it happened on the NBFC, on the financial service sector. Next one. So this was the friends. We discussed the way the progression. Then come 2018, we had the PNB debacle. I think somewhere it was in February 18, if my memory serves me right. And friends, I can tell you that basically I have been as a president from 2017-18, and I was vice president 16-17. I was interacting with Arun Jaitley ji as the finance minister, a lot of state ministers also, new state ministers coming, ministers of state coming in between, explaining what ICI is. And all of them were, agreeable that institute was running reasonably well, and there was no need of NFRA to be activated. Now, this was the only section, one of the two sections out of the 470 odd sections of the Companies Act. So the Companies Act came in 2013. Till 2018, these were not activated. Only reason was ICA was representing that, in whatever manner this is not required, and the ministers were agreeing. Though I would say the ministry officials felt differently, but the ministers were agreeable. They had seen the issue from close quarters, and they were, sort of. But PNB happened, and friends, believe me, Punjab National Bank episode, it was completely outside the books. And the internal auditor was not a chartered accountant, was a banker who was doing the internal audit of this particular branch. And the statutor's role till date, from 2018, 5 years have gone by. I don't think anybody has been able to sort of pinpoint the role of the statutory auditor as far as this came. See, this type of fraud happens, it happens. And I'll speak a little bit when I say about in the NFRA also. So this was what, sort of pushed the ministry to move. And I think even the likes of Arun Jaitley, who had given assurance that NFRA is not required, and the other ministers of state, they couldn't do anything. And NFRA got activated from 1st of April. And this debacle brought in the Fugitive Economic Offenders Bill, because these Nirav Choksi and the other gentlemen, Nirav Modi and Mehul Choksi, they fled the government. Vijay Mallya also had fled around about this time, the country. So they brought in this particular Economic Offenders Bill also. Please go ahead. So without the auditors being found, the statutators being found guilty, NFRA got activated. This was the tipping point which I wanted to highlight. Again, in 2018, this was the PNB debacle was around February 18. Come September 18, we saw ILFS, the biggest infra financing giant, it defaulted on their debt obligations. Minor ones. Totally, they had roughly about 1 lakh crore of borrowings. And there also the SFIO probe has revealed that the major lapses in audit. Now again, SFIO would see from a different lens, an investigator's lens. But I think these all matter of sub judice. Only once they come out whether what exactly went wrong, will come to know. And Government tried to ban the auditors, but which it could not do because the law doesn't allow that. Next slide, please. So these are the Grant Thornton report on the investigation they did. What are the type of anomalies? I think we'll not get into it. Maybe the next slide, just for information of the participants. Which this was subsequent to the fraud. Next, please. So, as I said, this all really started the NFRA to be brought in. And as we know, subsection 2 of NFRA says what its duties are to recommend accounting and auditing policies as well as standards to be adopted by companies, monitor and enforce compliance with auditing and accounting standards, oversee the quality of service of the professions as well with ensuring compliance with such standards and suggest measures for improvement in the quality of service. So this is under which currently the inspections are going on, the overseeing the quality of service. I think around 5 firms are being reviewed for the service under this clause as we speak. And I think others will be, in times to come, they will also be reviewed and perform such other functions as may be necessary. Next, please. So again, around this time, some new accounting standards came. These are very important. SA 701 on the key audit matters, as we say, CAM. So something which is not impacting the true and fair view, but the critical audit matters, how the auditor has dealt with, came through this SA 701 and SA 720, where auditors was asked to even comment on the other information, any board of directors report or any other management discussion and MDA analysis, etc., etc. So all the numbers coming there, financial numbers, were supposed to be confirmed by the auditor. And based on the above, even the whole, I think the audit report, as we knew earlier till that time, got changed in SA 700. We start with the opinion paragraph first and then the other thing. And same modification came in SA 705 also to the modifications, which we used to call qualifications earlier. And going concern also, the standard was amended, and we need to qualify in case the going concern challenges are there. Next, please. So this is on the NFRA. The first AQRR was released on 12th of December 2019. Again, I think to the bad luck of our profession, the first thing, generally what happens is the worst cases are picked up first. And unfortunately, even NFRA picked up ILFS as the first thing for its sort of review or investigation, or whatever you may call it. And the key issues which were noted is, first and foremost, is that the firms are not independent. And here, friends, they went beyond the law where even a network entity, maybe the ownership is different or whatever, but if they're part of the same network, the NFRA said they are not independent if you're part of the same network. Then again, the ICA code of conduct, the way it was interpreted was in a complete extreme manner. Then there were issues of failure of the engagement partner to direct supervise review. Now, in this particular case, if my memory serves me right, there were 3-4 partners involved. So who will do what? Their expectation of what the engagement partner to do. Now, this again, the flexibility of each firm to decide how they want to manage audit, which partner will do what role, in an audit. I think, again, the NFRA has come out with a view that the engagement partner has to do the following things: direct, supervise, review, almost all the, assuming some other partner is doing it, that is, not important. The engagement partner has to do it. And these are large organizations. I'm not talking small organizations. ILFS is large with number of subsidiaries and all. And they're dependent on the division of work the audit firm is having. So, independence evaluation, the risk assessment, audit plan, audit procedures, whether audit evidence was enough or not. And especially another area where they came down very heavily was on the discussions with those charged with governance, the audit committee. They said just making audit committee presentation is not enough. You have to have more engagement with, I think Govind will speak more about that. Professional skepticism, they commented on going concern assumptions. All this thing, I think we will request Govind to cover. Next slide, please. And as if this was not enough, this was somewhere in 19. Come March 20, we had the pandemic, and we as our auditors are completely, the way we do audit change, I think, post the pandemic. Initially, we didn't know what to do, then we did a lot of audits sitting at our own, I would say, homes, the respective team members. Large audits got completed, listed companies, though with, of course, a bit of delay. The clients were skeptical to provide data, and with the data privacy and all, also created the VPN, this, that, etc. The banks, were very, very, easy about giving data. All of them had to, so again, the way we do audit completely changed post the pandemic, which is even now what I see is most of the clients want now to give you data and not be at the site. Earlier, our audit used to happen and which had its own substantial advantages. It's not only auditing offline, but when you go meet people, interact with a lot of feedback you get. But if you're going to do it remotely, sitting at your own home or office, I think that's not good enough. I'm very clear on that. But the COVID sort of made the corporates taste, I would say, blood, where they say if the audit can be done sitting at the auditor's home or office, why do they need to sit at my place? So they cut down their space, availability, etc. And so it disrupted, I think, all the professions across the globe. The risk assessment we had to revise, the skepticism we had to increase. We became experts in remote auditing. We started using new technology, whether it's Microsoft Teams or whatever, VPN, this, that. And there were challenges on accounting estimates and even the going concern, because that time we didn't know how going concern is going to be, how will we certify the going concern of companies? We didn't know the horizon, what is going to happen in the code, at least till June 20. I think then July onwards, it started improving. So all the accounts finalizing till June 20, had large, challenges on going concern and subsequent event issues. Next, please. Then comes the CARO 2020. Friends, as I said, it was simplified into 2015 to 12 clauses, then increased to 16 clauses in 2016. And come 2020, it was increased to 21 clauses. And again, I will not go into the details, all of us. And at the same time, the Schedule 3 amendments also happened. Again, what is the relationship of the auditee with the struck-off companies? And a completely new process started, how to identify these things. So a lot of changes on the, so whatever wrong is happening in the corporate environment or in the business environment, I think the government or the regulators want it to be covered in accounts or by the auditor. So through the Schedule 3 disclosures or by the auditor in CARO. I think this again gives you, so anything wrong happening anywhere, you will have a law being amended and the disclosures increasing and the auditor's role increasing over there. Next slide, please. And post 2018, friends, this has been again a major change on the audit side. Is 2021 Reserve Bank change of the way the statutory audit of banks and NBS is being done, restricting the number of audits from 8 to 4 in case of banks, and in case of NBFCs, there are no limits to 8 NBFCs each firm can do. And again, each firm in a network, even if it is a network of firms, under one network, there are many firms, they can do only 8 NBFC or 4 banks. And if any of them have got more than 50,000 crores asset under management, it has to be, having 2 auditors minimum, they can have more. And it's a 3-year stint, which I'm told is being relooked at with the RBI. 3 years is a very small period for large entities, at least. And I'm told it is being reviewed. I don't know whether decision has come. And each company needs to have its own policy on appointment of auditors. Next, please. So again, the saga continues. In the interim also, between these periods, we had the ABG shipyard failure, a huge one. The Punjab and Maharashtra Cooperative Bank, which is called the PM, though it's a cooperative bank, not the corporate scene. The Yes Bank debacle, the DHFL debacle, and in UK, one of the biggest debacles was the Kerry Loan, and I'll speak a little bit more when we talk about the private report. Please go ahead. So these are the friends, the AQRRs which are done, audit quality review by NFRA, 6 of them, and I think 6 or 7, and financial reporting quality review reports. These are 4 of them. These are the annual reports, the financial statements they review, and a lot of suggestions have come. And I would request those who have not read the AQRRs or the FRQRRs, who are in audit profession, please have a look at them and your eyes will get opened up. Next. Yeah. So these are the issues which more will be discussed by Govind. So what NFRA has pointed out, as I told you, there has been no independence where a consulting firm and audit firm under the same network doing work. The auditing standards have not been complied with properly. For example, one, paragraph or one line is not applicable and auditor has not documented that, they say, where is it? So even if it is not applicable, there's no question of judgment, etc. You need to document it. Assuming you have done some audit, I'm talking audit evidence. So where is the proof that you have sought some information from the client? Where you what review you have done and what are the final conclusions? So each and everything has to be documented, the audit evidence. We discussed something on the TCWG. I think possibly Govind will speak more on that. Next, please. Next slide. Same way in the financial quality reporting reviews, the comments are on accounting policies, disclosures, Schedule 3, terminology use and accounting standards. Next. So what are the regulatory? This is very important. The NFRA chairman says there is a grave delivery gap in audits. So one other area where the scope and extent of auditing needs to undergo paradigm shift is in relation to understanding of businesses, says the current NFRA chairman, respected Ajay Bhushan Pandey. So he's suggesting that one should crowdsource the efforts to identify risks, as that will help auditors in meeting stakeholders' expectation as well as look into new risk areas. So we do crowdsourcing of the risk assessment, and the expectation of stakeholders have to be rightly addressed. There has to be avoid delivery gaps, evolve suitable mechanisms and means for the two-way communication between the stakeholders and auditors. Leveraging technology in audit needs to be done more. This is a suggestion, and developing global sustainability reporting standards in other areas of environmental social risk to the business and industry. So these are the current chairperson's expectations. I had an occasion to attend one meeting, closed door meeting in Trident, organized by CII. And one of the other expectation, which has not been mentioned here, is his expectation the auditor should cover fraud. And in the meeting, I respectfully submitted to him, sir, to Mr. Pandey, is, sir, fraud is investigation and audit is skepticism. And I told him that if we are going to start looking at all the audit from a fraud perspective, I think the time taken will be humongous, because each and everything will have to be seen, from a very, very suspicious eye, investigative eyes. And so time will, and I give an example. You have seen Satyam scam. We saw the other scams, whether it is ILFS problems or the DHFL or the whatever. For an investigation, it takes time, even after they detected as fraud. Forget, to come to the final conclusion, the evidence gathering on the fraud, etc. And today, the Indian corporates or, the non-corporates also, they need to close their financial results quickly for raising funds from banks, from, the capital markets, etc. So they're two distinct things. So expecting audit to, cover fraud, I said humbly, in my view, I think it's a wrong expectation gap. And if that is the case, then the time taken will be huge, and it will be to the detriment of the larger, macro, I would say the corporates, I would say everyone. There could be, I'm saying even now going forward, there could be some frauds. One cannot shy away from, but that doesn't mean that each and every auditee has to be seen from that lens of a fraud, detection, if I can say so. Next, please. So other expectations of NFRA is literal application of standards auditing. We discussed work paper to thoroughly demonstrate the audit procedure performed. They expect use of extensive data analytical tools and other procedures for testing fraud risk. They want us to evaluate the underlying basis of accounting estimate in a very detailed and digital manner, not just casual manner, in a very detailed manner, the accounting estimates. And a continued dialogue with the TCGW, those charged with governance, on audit matters, including discussion on significant matters, and proper and structured maintenance of audit evidences, and need to strengthen the quality control. So this is the expectation of NFRA. Let's move forward. So I think from our perspective, auditors, I think the challenge is whenever something, when any audit files are reviewed, the regulators have use of hindsight wisdom. They sometimes question the professional judgment use. I think judgment should not be questioned. And what I have observed in my case, whether it's a disciplinary committee of our institute or even some of these investigations, is the difference between mala fide matters and bona fide errors, minor errors. I think that distinction is not being used. They're looking at small mistakes also as something grave. I think that distinction should be there, and they're expecting surprise element in the audit. They said there's no surprise element left in the audits, whether it is cash verification, inventory, etc., etc. We should be doing surprise is their expectation. And our focus only on accounting standard compliance or the Ind AS compliance, I think, has to shift. We need to have equal or more importance to the standards of auditing also. And as mentioned, the audit evidence has to be demonstrable. You know, what you sought, what you did, what you concluded. Next. These are the remarks of the ex-NFRA chairperson, Mr. R. Sridharan. You're supposed to be speaking at the WRC, I think regional council, some seminar, and there could be last minute timing issues, and then he put up a speech on this thing. And this is very important for us. That's the reason I am highlighting this. That is his view. The expectation gaps must not be allowed to mask the serious failure of audit to deliver on its own current terms. If auditor delivered on the existing regime reliably and well, the expectation gap would shrink greatly. The delivery gap is far wider than the expectation gap, and that is what must be fixed as soon as possible. And going further, for those who would nevertheless recall the watchdog method, we always say we are watchdogs and not bloodhound. With something like nostalgia, I would recommend a read of the Sherlock Holmes short story Silver Blaze. Holmes draws attention to the curious incidents of the dog in the night time, a dog that did nothing because of the identity of the criminal. I think this is very, very important, message which he has given. I think we should do audit delivery so that there is no delivery gap. So the expectation gap will minimize if you are doing audits thoroughly. And second is the issue of watchdog versus bloodhound. Even as a watchdog, here only again feedback to our dear audiences. Though Mr. Sridharan has said whatever he has said, I was chairman of the Qualified Audit Report Review Committee of SEBI, and I remember out of 6,000 listed companies, this is the first time any regulator started looking at the qualifications in the auditor's report, as we now call them modifications. And if my memory serves me right, this was way back in, I think, 15, 16 or so, around 500 plus companies who were having modifications or qualifications out of the total gamut of 5,000 to 6,000 listed entities at that point of time. So almost 10% had, which is a huge number. So the issue is none of the regulators have taken the auditor's qualifications of audit seriously. First time SEBI did that. And even now, I think other regulators are not taking it. They don't understand what these are. They don't want to take action on the companies based on the qualifications. So I think that would be my suggestion, accepting the fact that our delivery has to improve and we should remain watchdog. We should not remain silent, in case there is an incident in the night time or whatever, just because of the identity of the criminal. Next, please. I will not get into, they are suggesting an e-locker for our documentation. So the moment audit is over. Friends, again, only thing I would want to point out over here is, as for the auditing standards, we can complete a document 60 days. But NFRA expect that it should be done, contemporarily, and there should be no document which should be done post the signature of the audit. That a lot of comments are there. The audit report signed on so and so, certain documents were taken later. And I know one large firm which earlier had a 30-day window. They are reducing it to 15, from 15 to 7, 7 to 2. That is the way forward. And this again feedback for all of us that we need to quicken the document. It should not be that audit ho gaya baad mein apan documentation pura karte hain, jo earlier we used to do. That will no longer be acceptable. And the annual transparency report, they came out with a discussion paper. I think some comments have been given by various institute, also by Bombay Chartered Society. I think chamber, we couldn't comment on this, but let's move ahead. Time is running out. Quick. Yeah, please go ahead. So this is the quality review board. Just last slide. Which for last 10 years, whatever quality reviews they did, number of companies they have done. And so this is the case. 196 cases were closed in these 10 years without any comments. 373 cases advisories were issued by QRB, and 35 recommendations were made to institute for necessary action on various standards, etc. And 32% were generally acceptable, 62% improvements required, and 6% were significant improvements required. And some of the matters have gone to the district committee also, is what I'm aware from the review of the quality review board. Next. So these are the number of observations. Please go ahead. So this is the year FY20. So you'll see how much progress has been made. Now, generally accepted is 8%, improvements required 92%, 2 cases closed, and 22 advisory issued. These numbers have gone down in this year, possibly because of the pandemic and also because of the NFRA coming into being, so now there is a rule to what those situation is going on. Next, please. These are the auditing standard-wise comments. Maybe later on, this is the statistics out of the annual report of the QRB. You can see it later. Next. These are the accounting standards-wise observations. On the left-hand side is the accounting standard. On the right-hand side is the Ind AS. How many entities are having observation on the Ind AS based on the quality review? Next. Bryden report, I'll just take a minute. Friends, as I mentioned earlier, in UK, there's a huge debacle called Karelian. And based on that complete, in UK, this Bryden committee was set up and the report was there, and lot of suggestions in the Bryden committee report, lot of substantial suggestions are there. They also discuss joint audit. Somehow they are not going ahead with it in UK is what I'm told. They also discuss the segregation of consulting from audit. The audit firm should not do consulting, especially in the clients with the auditors. So that again is signal. In India, of course, as small and medium-sized auditors, we do audit, tax, GST, or maybe other advisory work also. But this is in UK, they are out to. In fact, one of the large firms have already decided to segregate the audit and consulting across the world, and major jurisdictions are changing, is what I've told. Some jurisdictions there's a challenge. Next. So this, friends, is last couple of slides. The audit quality maturity model has been, was recommendatory for last year. It is becoming mandatory from 1st of April 2023. ISA has developed this. There are 280 possible points in practice management operation, 240 points in HR management, 80 points is in the practice management strategic and functional, total 600 points. So we need to do self-evaluation and start working. And friends, believe me, as a firm, we are also doing it. And I think by and large, on the HR side, a lot of things need to be documented. We may be doing a lot of things, but the question is, are you documenting it, how you're doing, what you're doing, especially on the quality side also, on the quality controls on the audits, etc. So I would seriously suggest that take this up very seriously. It will help you improve your, not only the audit quality, but more importantly, the documentation. Next, please. Yeah, this again is AQMM. There should be a separate session thereon. These are the different type of forms. Level 1 is the lowest form, level 2, level 3, and level 4 is the best form which will be there. And this will be posted on the issued website after this, and this will be done along with the peer review. Next. Now, friends, this is the last slide. I have taken much more time than required. Govind, my apologies. So what is the new terrain which we do this? So there is a disrupted traditional audit approach. The way we are doing audit is completely changing. The traditional approach has gone to the winds. We need to change. There's been continuous push for audit reforms. You have seen in the last 10, 12 years, the way it is going with Companies Act, NFRA, so on, AQMM, QRB, name it. Fraud risk, which auditors should see, that is elevated now from a fraud risk perspective. And so this is one area we need to be watchful of. The business models are changing. The whole business environment is becoming tech-driven. And even in audits, accounting already, I think a lot of RPA and machine learning is happening on the accounting side. I think we need to start harnessing our, robotics and machine learning on the audit side also. Very important suggestion from my side: please avoid getting any taintedness. If you know they're tainted right at the beginning, because there's a huge challenge later on which will happen to you. Of course, accidents can still happen. With good names also, accidents can happen. But if you know certain name, please don't get associated, otherwise you will be in trouble as an auditor. And the audit is now, as the expectation is moving from a professional skepticism, they want us to go to more of forensic. I don't know how far practicable from a timeline perspective it will be. And final request to you, friends, is there is always a client interest and a public interest. We as auditors have public interest also. So till now, a lot of focus has been on client interest. I think a substantial focus also has to be on the public interest. So with that, I would want to conclude my sort of brief overview of what is happening in the last 10, 12 years. Thank you very much.
Utsav is raising a question that NFRA does not have sector expert and subject matter expert, and hence it's very difficult for them to see the documentation, especially for professional judgment, which are relied upon by the auditors or which are made by the auditors. Hence, it's very impracticable also at times to document each and every matter. So as an institute, are we representing to the regulatory agencies?
Very good question, Utsav. Thanks. I missed that. Friends, I think it is very, very unfortunate, if I can say so. In the first term of under the erstwhile chairman, Institute has got 3 nominees on the board. We have got the president of the Institute on the board. We have the Accounting Standard Board chairman on the board and the Auditing and National Standard Board chairman on the board. Ex officio, they are on that. When these reviews happen, it is so unfortunate. See, today I'll tell you in FRRB, PRB, there is a system where first a technical review will be appointed, then it's looked at by a group, and then finally by the board. So there's a 3 level, and that framework has been decided by the council, how this will be done. Unfortunately, in FRA, what has happened is all these review reports have been possibly by the feedback I get is by the executive function. The framework, how the things will be done, should, in my view, should have been decided by the board, which consisted of the issued nominees also, and maybe other, I'm told the other, CA representatives also on the board. So they could have given them some perspective. Finally, they could have decided what to do. But the framework, how to do the inspections, what should be there, so nothing has been, sort of, in the erstwhile, I would say, the NFRA. Now, tremendous engagement with the current, after the new chairperson has come, there's a huge engagement, and I hope all these matters will be addressed. And especially, see, I've been pushing the institute on the interpretation of the standards. There are difference of interpretation, the way the profession interprets, the way the NFRA is interpreting. So this has to be, they have to sit down together and discuss and find a way out. I can interpret a thing in any manner. I can, there are 2 extreme manners, and there's a mid path for interpreting anything. So I think in my humble view on certain matters, not all matters, the NFRA has taken very, very extreme view in interpreting the standards of auditing or the code of ethics, whatever. But be that as it may, that's my individual view. I may be wrong. But the best way is for the ICA, the Institute, and the NFRA to sit down together and sort it out. Now the engagement has increased a lot, is the feedback I'm getting from the current council members.
And I just want to kind of add on one comment to the response which Nilesh Bhai gave. And Nilesh Bhai, we were there in that meeting together when we met the NFRA president. I think NFRA chairman. I think one thing you could see is that they're far more positive and open. In fact, they were asking for our inputs. So I think to Utsav's comments, I think that dialogue in the new regime of the NFRA, I think is at least the first steps we are seeing are very positive. I think there is a collaborative approach which is being demonstrated by them in the opening forums, and they are seeking comments from us. So I think, as you'll appreciate, NFRA came in at the backdrop of ILFS, as Nilesh Bhai explained, and then there was COVID. So I think it's a new regulator. They are coming up with new guidelines. They are coming up with new ways of doing things. So it takes time for settling down. But as Nilesh Bhai said, with the active interactions of ICAI and NFRA, we will probably see some meeting ground on this topic. So I think we'll just see how the next 12 to 24 months pan out vis-a-vis these inspections which happen. So with this, I'll start my discussion. And I think while Nilesh Bhai has given us a very nice overview of the last 20 years and very nicely to set the context of this discussion, which is more, I would say, specific to what we need to do as practitioners. And one thing I would like to kind of share with the group over here before we go into our discussion on the presentation. While, we appreciate the fact that a lot is being expected from us, a lot of focus is coming on what we do as professionals. And I think the last words of Nilesh Bhai, they echo in my mind of public interest, right? The public interest is important for us. So what does it mean? It means that we as professionals, we need to uphold that trust which people are putting into us. And in that process, we will have to stretch out and do things in a different way, because there's an expectation of the market. At the same time, we are professionals. We have to up our own curve, our learning curve, our experience curve, our execution curve, to be able to make our role more prominent and justify the trust which people put onto us. So I would say, while what I discussed in the presentation may appear to be overwhelming at times, I think we, just like all of you, have gone through these journeys of learning about documentation, learning about how do you kind of document professional judgments, learning about how do you face inspections. And I believe that with a little of effort, a concerted effort, and a lot of collaboration amongst the members, which is over here, we will be able to kind of meet these challenges of tomorrow. I just want to leave that positive thought, because I don't want it to be like an overwhelming thing that we have a big mountain coming our way. I think we will have to kind of climb the mountain together, as you would do in any other professional situation. Yeah. So with this, I'll share my presentation. What we will cover in the presentation today is more of an overview, and I will go a little more detailed in the overview in terms of the current environment we are in. I'll just share with you the changing focus for inspections. And these inspections are coming from, say, Indian regulator like the QRB, like the Peer Review Board, or for that matter, NFRA. And we'll also then also look at how it happens in the PCAOB world, which is the US regulator for US listed companies. And then again, coming out of this experience of learnings, what are the key learnings and response for all of us? One thing I'd like to kind of put a caveat, not in a typical auditor sense, but still, it's important for all of us to appreciate that, you know, the areas which we are discussing in this presentation are only for your information. They are not the complete list of all the possible areas which can be subject to an inspection, you know, because as you'll appreciate that, you know, we're just covering this as a capsule on the key items, but we'll also have lot many areas which could be important to in any of the inspection. Again, I'm sharing with you this all of this in the personal experience, you know, while I have my coordinates in this presentation, and this content will be shared with all of you, but this remains whatever we discussed today will remain my personal opinion as such. Coming to the overview, and I think we touched upon managing increasing expectations, but I'm just talking about the environment today and for the next 3 to 5 years. You know, our market, our economic market, be it India, be it global, has never been more complex, right? We are seeing ever-changing economic environments in India and global. We are seeing a lot more volatility, but a lot more promise given the India potential, right? And you know, India, given the growth potential India has, we know that India is the market for the next 5, 10, 15, 20 years as such. So we are in a good market to be in. And we also can also expect a lot more investments, a lot more attention, and hence a lot more expectations of professions such as chartered accountants to give the assurance required for that growth, for the growth capital. We're also looking at a lot of constraints, and the constraints are coming on account of the events, like Nilesh spoke about the impediments of corporate failures. We also at times note events of lack of governance. These impact investor confidence, and this also impacts at times talent. So I think it's important that, you know, how do we kind of manage this constraints in this high growth situation. Complex reporting requirements introduced for corporates and auditors. I think we spoke about Schedule 3 and CARO, and many, many more things. This also we touched upon, you know, a tougher regulatory environment for audit profession, and a more challenging role for auditors with inspection oversight. So be it NFRA, ROC. Today we are seeing MCA. They read financial statements of companies and they give comments to auditors, be it private, be it public. So ROC also has become active. SEBI at times makes inquiries of companies' financial statements straight from the auditors. FRRB and QRB and ICI, we are all familiar with, and we spoke about that. So coming back to the expectation, right? And expectation is that the auditor should detect fraud. Auditor should include investigative procedures. That is the expectation. And again, we'll discuss that when you come to the slide on risk management, on risk commentary on this statement. But important point is that we cannot overnight change from auditors to investigators, because investigation is a very different ballgame. Audit is a very different ballgame. It's a very focused approach with a certain methodology of looking at the accounts as true and fair. However, it's also important, as we understood, heard from the quotes of Mr. Sridharan, there also is a very famous quote which says that there's no issue if the auditor doesn't detect a small fraud. However, the auditor should not shy away from calling out the elephant in the room. So basically, the message is that the auditor should not just say that, okay, I'm not supposed to identify a fraud. However, if he sees a big fraud happening, auditor cannot close their eyes to that. What we also see in the overall challenging environment is not only the audit regulators, but also the other regulators. For example, the SFIO, the ED, the EOW, CBI. When they investigate any instances of corporate fraud or corporate failures, they are now reaching out to auditors more and more. And this is where it gets very complex, because a particular auditor could be subject to a regulatory inspection, which is from the law enforcement agencies, as well as from the audit regulators. And that creates a lot of complications. So this is more on the external side from a regulatory point of view. But if you come to the board, what we also seeing is that the board and the audit committee, the promoters and the management, they are expecting a lot from the auditors. They're expecting a lot from the auditors on all fronts. be it a high quality audit, high quality analytics. They're expecting a lot of value inputs. They're also expecting the auditors to give them feedback on internal control. They're also expecting auditors to give them feedback on frauds and on compliance with laws and regulations and compliance with taxes. So we are seeing that the expectations of companies also they've always been high, but they always keep increasing. And with more and more oversight coming from board and audit committees, and we are seeing that this question coming more and more, that are the audit teams or the audit firms involving more senior and experienced auditors, and that too early and throughout the audit process. So, if I go back 20 years when I was doing, before I kind of got into the CA and I was doing articleship, for us, the reviews happened more towards the end when the audit was to be signed off. Today, right from day one of the audit, you're seeing a partner, you're seeing a team members participating in the discussions on the client's financial statements and issues right from day one. So that is the expectation which is coming from the board. Now coming to the key question, do we have the bandwidth? And this is very important for us as professionals to do, is that, we can only do so much with high quality. If you're having too many clients, then you can't give the equal amount of effort or a right amount of effort at each client. So there's always a limited bandwidth for audit partner and their team to perform a high quality audit. So that becomes an important aspect when it comes to looking at the increasing expectations. So what we're going to cover today in this discussion over the next 30-40 minutes is to share with you the key observations from the external inspection reports. And this is more focused on the reports available in public domain. I try to keep that, and Nilesh bhai gave us a very good cue of looking at the AQRR reports that are on the NFRA website. So I've used that to kind of identify the key observations and also the QRB study which came out. So I think I've used QRB and NFRA as the key observations coming through in this presentation. And also, what should we do as practitioners to prepare for meeting the new expectations? So these are just broad concepts. As you can appreciate and imagine that 1 hour discussion or a 30-minute discussion, we can only discuss the big picture. So I'll try and attempt to cover that with you in this discussion. Objective is to demonstrate adherence to quality control and auditing standards for the execution of audit of having thorough written documentation. This is the objective with which we need to kind of look at doing our audit files. So with this, I'll now get into the what is the overview in terms of how we kind of see our responsibility. So if you look at overview, as an audit leader or as an audit partner or as an audit professional, you have to have a good understanding of the economy and the outlook and the sector which your clients operate in. You also need to have a very good understanding of the business and operations and financial health of your clients, because the expectation, as Nilesh bhai said about the NFRA chairman, the expectation is that we are addressing business risk. We can only address business risk if we understand business. And that's important for us to do, because if we understand business, we'll be able to understand how the financial statements impact the business risk as well. We, as auditors, need to understand the board, audit committee, and the senior management controls. This is again very critical because we cannot do 100% audits. Those days are gone where you pick up the entire general ledger and start auditing each and every transaction. You have to look at a controls-based approach. And this is very key to any, I would say, smart audit. We also are required to kind of focus on operating and financial controls, with internal control of financial reporting mandatory for many companies. This becomes very key in our audit process. This was discussed by Utsav also on significant and other judgments. This is very key because audit at the end of the day is an opinion. And opinion can vary across two professionals or more than two professionals. So how do the judgments and estimates get understood, addressed, and documented is very, very critical. So this is very key again to any audit process of understanding the key judgments and estimates. And going concern, impairments, and ECL are the most common ones which are impacting most corporates and most auditors today. So I think it's important to understand these judgments when you're forming a view on any financial statements. And last but not the least, understanding the regulatory matters. So while we can say that income tax has gone to a simplification mode, GST is simplified, we're also seeing that with corporate law coming in, SEBI changes coming through, there are lots of regulatory changes which are coming through, which are impacting the clients and also generally as well. So it's important to understand what regulatory changes can impact the audit we do. How do you address this? By having a strong team. So sharing of experience, I think one of the key things I have kind of learned is from my own leaders, from my own bosses. And the same thing which I take back to my team as to how do we make our professionals, our younger generation, our interns, our executives, our chartered accountants, much more stronger in terms of experience. So sharing of experience has been the best way to address the risk of, having a good quality audit, on-the-job training of teams, making them understand of accounting and auditing concepts, formal and informal communication. As I mentioned to you earlier, audit review would happen by the partner maybe at the end of the audit, but having formal and informal communication through the audit process is very key today to ensure that there's enough dialogue happening with the leadership of the firm and with the teams who are executing on the ground. Early identification of issues, very, very critical, because you can only address the issue appropriately if you have no stress of time. So early identification helps you to understand the issue well, do a discussion with the company, consult others if you have to, and then take an informed view. If you have an issue coming up just one day before the audit report sign off, it's very difficult to get to the right answer. Maybe you have to get to the answer, but the answer may or may not be right. Focus on frauds and whistleblowers, I think very, very critical in today's era. Lots of companies are getting short seller reports, and this is coming more from the Hindenburg example we saw. So the short seller report. But this concept is not only new to global, but also now getting new to India. And more importantly, news in the media. A lot of information is in the public domain, but many times we're not even aware of what's happening in our client. Always good to kind of see what's happening. And last but not the least, consult. I think one important point when it comes to practitioners is that when you consult, maybe you're a person with only one or two partners, but if you have to consult outside the firm, please be careful about the confidentiality and code of ethics. So we can only discuss information about our client where our independence is not getting impaired and where we maintain confidentiality. So consult with others. You may consult on a no-name basis. That's the best thing to do, but get the wisdom before you conclude on any audit topics. Again, this is an expectation. Again, I'm just quoting this from what I have experienced in the last many years now. And of course, looking at the PCAOB inspection or maybe the NFRA inspections, audit partner and team are required to understand the business, understand the risks and controls, and demonstrate skepticism, challenge management, and apply judgment and evidence involvement. So you are supposed to have evidence of involvement and leadership in audit engagement. So there's a lot of evidence required in the work paper file. And now with this, I'll change my gears to what are we looking at, the changing focus of inspections. This is just a slide which I have put together purely from my own experience. And again, this is more, I would say, the last 5 years of change. As I said, I've interacted with the QRB. I've interacted with the PRB, the peer review board, for the inspection of our firm. I've also interacted with the NFRA teams, and I've also inspected with the PCAOB teams. So when I look at all these 4 regulators, and I'm saying that, the earlier focus was very different. And I just want to kind of cover this first, column first. Earlier the focus of the inspection was a quality of an audit file. And there was an inspection of an audit engagement file. They would pick up a select number of files and test audit the quality on those audits. The focus would be on documents which are provided to the reviewer. The focus would be documents available on file, whether it was provided by the auditee, by the company, or by the auditor to support their audit work. The reviewer generally in the earlier times, and even currently when you come for QRB and peer review, they interact with the engagement team only. Inspection team would be generally one reviewer. The experience and knowledge will be dependent on the reviewer. If he's from with the number of the other experiences high, the questions will be different. If it's a younger reviewer, then the questions will be different. And the inspection period would be generally a few days to a week maximum. So this is what we have seen in some of the inspections earlier. But what I'm seeing as a change coming through, and this actually very much what PCAOB does and what NFRA is trying to get to, is focus on the system of quality control, SQC1. Focus on SQC1 and understand the quality of the firm's processes, including its governance, rather than focusing only on an engagement. Inspection covers not only an audit engagement file, but also adherence to the firm policies. So they don't even kind of look at, okay, let me get to a given engagement and review it. They would say, okay, if this is your firm policy, tell us how the policy was applied. So the focus is changing from engagement review to a system of quality control for the firm as a whole. And very, very important, as I mentioned to you, and you'll hear this a lot from me in this meeting, is about documentation. There's a gospel which says, right, that if it's not documented, it's not done. So the audit file should be self-speaking. It should be documented. If it's documented audit file and it's an independent objective experience reviewer can understand that, then the file is of good quality. That is the way they approach documentation. So that is again the focus. review of the firm policies, documents supporting adherence to policies. And earlier it was documents provided, but now it's the complete audit work paper file. So the entire file is taken by the regulator. They can choose whatever area they want to review. It's no longer that give me a work paper on revenue, give me a work paper on property, plant and equipment. It's no longer that. Now the focus is, please give us your entire work paper file and we'll decide what needs to be reviewed. Focus, very, very important. Having a client document on file is not good enough. There has to be evidence of audit work performed on that work paper. The questions that you get asked in an inspection now are, when were the work papers prepared? There has to be a date, a time. There has to be the name of the person who prepared it. Who prepared the work papers? Who reviewed the work papers? Did the partner review the work papers? These are the questions which come in inspections, and there should be evidence to support all of these. Did the engagement quality control review or review the work papers? Meetings and interactions, earlier with only the engagement team, but now the expectation is that PCOB, NFRA would like to meet the firm's leadership first. And then they meet the engagement teams. And then they try and understand whether they got the same message or not. There are multiple reviewers who come in a PCOB inspection or an NFRA inspection. These are all experienced reviewers. They are subject to inspection training, and they have support of senior and experienced auditors from the inspecting organization. So PCOB, when the team comes for inspection, they would go back and they would then have consultations internally on our file. And then they would come back and tell us, ask more questions. Similarly with NFRA as well. And the inspection period generally is not just a few days to a week. It's now 3 to 8 weeks. So the entire focus is, as I said, moving on a very different slant in terms of how inspections need to be done. So with this, I'll move on to the key themes. I think Nilesh touched upon this, but I'm going to spend just about 2-3 minutes on each of these slides just to share with you what are the observations coming through in inspections, and based on the observations, what becomes the expectation. So this presentation is more about what we should be doing. So I'll be touching upon these points in each of these 13 themes. So I'll touch upon SQC1, audit documentation, materiality, analytical procedures, auditing accounting estimates, identifying risk of material misstatement through understanding of the entities and the environment. This is a very important topic. Topic number 6 is actually the core of our audit. So this is very, very critical that as the auditor identified the risks of material misstatement. External confirmations, going concern, ICFR, subsequent events, written representations. Quality control of an audit of financial statements, SA 220. Again, this is another very fundamental standard, which is also very core to how the audit firm operates and how the audit got executed. So if I were to kind of look at, and the last one is of course communication, those target governance. So on this slide, if I were to pick up the 3 most important ones, would be item number 1, SQC1, identifying and assessing risk of material in the statement, and last is quality control for an audit of financial statements. These are 3, I would say, the anchor observations, and then others are, as I said, they are just coming as observations coming from the inspections. And I want to kind of restate the caveat now. These are not all the observations. So I'm just sharing with you the significant ones which are important for us to discuss today. With this, I'll go into the SQC1 principles. And again, as I said, I'll keep talking about documentation, right? So compliance with SQC1 is one of the most fundamental principles of running a audit practice. This is irrespective of the inspections, because at times we feel that because it's being inspected, we should do it. That's not the case. SQC1 has been there for 10 plus years. So we are required to be following SQC1 for running our business. And what does SQC1 require? There has to be a system of quality control designed to provide it with reasonable assurance that the firm and its personnel comply with professional standards and regulatory and legal requirements, and that the reports issued by the firm are appropriate in the circumstances. So this is actually the principle of SQC1. And it's important that the nature of policies and procedures developed by the firm to compare SQC are documented. So the firm's leadership system of quality control should include policies and procedures addressing each of the following elements: leadership responsibilities for quality within the firm, ethical requirements, which is independence, very fundamental to our audit, acceptance and continuance of client relationships and specific engagements. I think Nilesh touched upon the concept of tainted clients, right? Or tainted names. So I think it's important that are we working with the right clients? The human resources, very critical to the way we execute our business, engagement performance, and lastly, monitoring. So I would, it's a very old concept of SQC1, but I'll still encourage all of you to just think through that and reflect back on this question, that when you look at your audit business, do you have all of these 6 elements documented as a policy or procedure? If you don't have it, you'd start developing this. And it's very simple. I'm making it very simple, but if I read the standard, they give a lot of guidance as to how do you document this. So my request to all of you would be that go back to the standard, look at the standard and see how best you want to write down your policies. Nobody is expecting you to write 1,000 pages. Nobody is expecting you to write 100 pages. But even if you write 15, 20 pages, depending on the size of the firm you have, depending on the kind of clients you have, depending on the number of people who need to review this policy and how deep you go, you can decide the length and breadth of the policies. So there's no yardstick as to what the policy is and the length of the document which you should have. But it's important that this aspect is addressed. I would like to take a pause over here for like 30 seconds and digress for 2 minutes on ISQM 1. So while we're talking about system of quality control, this is the standard which is currently in operation for practitioners and for audit firms. But as you appreciate and as you know that globally, this year, ISQM 1 has become mandatory. And ICAI, it's expected to come through, will adopt that standard possibly in a couple of years from now or 3 years from now. So SQC1 is a building block to go to ISQM 1. So my thought, my request is that please consider SQC1 as fundamental to doing audit business, and at the same time, be prepared to move to ISQM 1. So it will also help you to transition to the new standard as and when it comes about in India. Moving on to audit documentation. This is something which you have heard multiple times. You must have read multiple times. But the biggest issue is on implementation. And I can share this to you with some level of conviction that, after having done documentation in all formats, be it manual, be it Excel, Word, PowerPoint, digital, be it looking at data analytics and bots, documentation continues to be the biggest challenge for auditor today. Any size of the firm, big firm, small firm, anybody. What is the issue in documentation? The issue in documentation is that documentation has to contain sufficient and detailed information to understand the findings and the issues, actions taken to address the issues, and judgments applied, and detailed documentation on high-risk areas and complex accounting estimates. Now, this may sound very simple, but what happens in audit, even in a very simple audit, which is a cost-plus company, you may feel that there's no issue, but there could be an issue on transfer pricing, right? Because in cost-plus, what can go wrong? Your cost is there and your revenue is fixed, but what could go wrong? Something could go wrong and possibly in tax itself, if it's a transfer pricing issue. So it's important to look at this to be the most important element of I would say training and coaching within the firm. This is single most I would say effort area which requires time. So if I have to look at the audit execution time, and I can tell you, Yamal and I have been working for many years now in this business. If you look at audit execution, if I spend 1,000 hours in an audit, I may spend 15, 20 hours probably in looking at the key issues. I may spend another 80, 100 hours in looking at the key judgments and estimates. But, we spend almost 500, 600 hours on documentation, because whatever you've done in the 100 hours has to fit somewhere in your work paper. And that's why this becomes the core of the audit. And this requires a fair level of training and coaching. And again, I don't want to make it overwhelming, but it's about just one experience and then becomes more of a habit. So documentation is extremely key when you're looking at inspections in today's environment. When an auditor is challenged by an inspector, I'm not calling it investigation. Investigation is different. I'm talking about inspection. When the auditor is challenged in an inspection, then the auditor will have to demonstrate from the work papers that they were able to kind of they are able to support what work they did. So in an inspection regime, which is not investigation, even if the documentation is clear as to how the work was done, that should be appropriate. There could be a challenge where the inspector may feel that documentation is more or less, but that is something which is a matter of judgment, right? That how will you ever get to the same answer? It's opinion. So documentation, as I said, even if you, in your own professional judgment, you document something clearly, that should be good enough. Basis of professional judgment exercised by the auditor being challenged. So, when auditor, when we write work papers, one of the key issues in inspections is that, how was the judgment of the auditor exercised? And at times you get a challenge on that from the regulator. Only the person who's prepared the review the document should sign the document in the audit file. So one of the key issues which we see is at times, we may not, person A may do the work, but person B may sign off. That is something which is not acceptable. And this is something which you are seeing coming up in the NFRA reports which are in the public domain. So if the work paper is signed by the person other than the preparer or reviewer, that will certainly lead to professional misconduct. Care should be taken and self-review of work should be done to ensure the documentation is detailed enough. Work papers have the correct references, and different work papers are consistent with each other for the same matter. You can't have inconsistency in the work papers. Timely conclusion of strategy and timing of documentation. Again, it's more important in digital environment where there's a footprint of the time being spent. But if it's a manual file you're putting together, still you need to have evidence that the timing of the audit strategy and timing of conclusion was done at the right time. Self-sufficient work papers, no reliance later on email, data and laptop, backup, hard copy. So if you say this is a work paper file, and so you're going for an inspection, you cannot come and say, oh, I have 3 work papers in my email. That will not be accepted to any inspection organization today. The expectation is that print that email and keep it in your file. An assembly of final audit file should be in compliance with the firm policies and procedures as per SQC1. I think SQC1 has some guidelines around how to go about the file maintenance. So please, again, go back to SQC1 and see what is required from the standard. And the firm needs to have controls over retention and maintenance of integrity of the audit file. I think this issue came up in the NFRA inspections where if the audit partner or audit team had signed a work paper after the date of the board meeting, NFRA felt that the work paper was compromised. Of course, that was the extreme view, and we have yet to see how that eventually gets closed. The expectation, as Nilesh also explained, is that after the board meeting date, there should be no work paper changes. That is the expectation of the regulator. Moving on to the other topics, planning materiality. Again, I'm going to just touch upon these topics and then we'll try and get to some questions and answers towards the end of this discussion. So planning materiality, we are required to appropriately identify and document the users of financial statements and the expectations. So whether the shareholders, banks, debenture holders, or rating agencies, analysts, regulators, we should document what is critical to the users. We are supposed to document materiality at both the planning stage and conclusion stage. We are required to apply qualitative factors to identify significant accounts with balances lower the materiality. So I think it's important that when you look at materiality as a number, it's not just a number. You also look at qualitative aspects. So if account caption is not more than materiality, but it's important for you, for example, managerial remuneration, right? It's very critical to the payment of compensation to a managing director. So even if it may not be material to you, it's important to get to the accuracy of that number. So auditor has to decide that based on his judgment. Clearly, document how materiality was used to determine the nature, extent, timing audit procedures. Document basis for conclusion for qualitative factors. And ICAI has not defined any materiality thresholds. But if you look at the auditing standard, they say that for a normal business income company, you can use 5% of profit before tax as materiality. And if it's a startup or a loss-making company, you can take 1% of assets. But those are thresholds given in the standard as an example. But ICAI generally has not defined any materiality threshold. But by rule of thumb, people use 5% of pre-tax earnings if it's a normal company, and people use 0.5 to 1% of total assets if it's a loss-making company. So the other element is on analytical review procedures. We are required to, under auditing standards, supposed to use analytical procedures during planning phase for identification of risk. They should be beyond the flux analysis. So what many times you see in practice is, you just compare 1 year to the prior year and you look at the variations. That is good as a starting point. But it's also important to understand at times what is happening quarter over quarter, month over month. So it's not just prior current year, but also looking at other tests within the flux analysis, which can give you some trends of issues. So analysis between various elements of financial information and between financial and non-financial information. And this goes without saying that analytical review is not about revenue, but revenue and debtors put together, right? Payables and creditors put together. Likewise, you can do EBITDA with debt. Those ratios are always having a relationship as to how the debt gets serviced. So I think it's important to look at the various elements of financial statements and look at analytics in that way. Ensure all material variances are investigated and documented. I think it's a very important point that many times people think that by just saying that this is based on management discussion, that's not good enough. We need to have an understanding as to why the material variations were happening and explain that as such. And ensure proper documentation, including formulas used for the variances. Again, this is more coming up as an experience from a documentation trees. Moving on to auditing of estimates. So, this is something which is, again, very critical. And I think also made this comment earlier. I think how the company has addressed a judgment or estimate is important. So many times the company uses a third party. They may use a valuation expert for something, or they may use their own internal valuation experts. So how was the management's expert, how is competency addressed, capability and objectivity addressed? And that should be documented in the audit file before we kind of rely on the book data. Auditors are also required to perform procedures in order to determine reasonable of the assumptions used. So I think it's not just taking a number and saying I took a letter of representation or a management representation letter. If it's an assumption being used in a critical estimate, for example, an impairment risk, then that assumption for growth of revenue or a discount rate has to be appropriately tested by the auditor by way of challenging it and also documenting why the auditor is comfortable with that. This is a very complex topic. I will not expect this to be easy. Even in a very simple of the simplest companies, an auditor to document the reasonableness of assumptions is very, very difficult because we're not used to it, right? We generally are looking at a cash and bank balance and completing audit work, but we don't look at future related data in the same way. So this is a very critical area of auditor having done enough procedures to document the assumptions and methods used by management. Procedures performed by the audit team over management assessment and the professional judgment made by the auditor in concluding on high-risk estimate areas. All of this has to be documented. As I mentioned to you, I'll keep saying documentation again and again, because that's the only way we'll demonstrate we did the work. In case of critical estimates and balances, involve experts. So you can also involve your own experts, whether it's experts in your firm, or you can also go to external firm for help in case you need to involve somebody, a specialist, to address the management expert assertion. And if you get any expert opinions from the outside, if there are any caveats in the valuation report or any legal opinions, etc., you need to document how the auditor dealt with those. Because just imagine if you are subject to an inspection and you have for a critical estimate relied on a valuation report, and the valuation report has caveats. I didn't do testing of the assumptions. The risk will come on to you as an audit partner, audit firm. Then why did you rely on that or a valuation report if there was a caveat on assumptions? So it's important that the auditor addresses that in the audit. Risk of material misstatement, as I said, this is one of the pillars which I spoke about earlier. So ISQC is one, risk of material misstatement is second. So risk of material misstatement should be specific to the risk factors identified by the engagement team. It should be done during initial stage of the audit, and you should do the reassessment at year end. Inquire with internal auditors for risk of material misstatement. So talk to internal auditors, talk to audit committee, talk to management, do your analytical review procedures to identify risk of material misstatements. And once you've done the identification, then you do audit procedures around risk material misstatement. So for example, purchase of investments or recoverability of debtors. These are risks of material misstatement, right? What is the company's control over that area? How will the auditor test that area? Should be part of the documentation. So audit procedures around ROM should include control testing, substantive procedures, and also include special considerations. Ensure consistency with the papers. That's another finding which came in the NFRA inspection on the reports that are there in the public domain. Next point is very important. Risk of material misstatement is a very, very key topic, as I mentioned to you, to any regulator and any inspector. There has to be appropriate focus on having detailed minutes of meetings with management and those charged with governance with respect to risk of material misstatement due to fraud. As you'll appreciate, fraud is a mandatory procedure for auditors, but we generally do this only in audit team discussion. Regulators are now expecting that this discussion on risk of material misstatement due to fraud should be also discussed with management and documented, and also talk to the audit committee and the board. Of course, we don't talk to the board as much, we talk to the audit committee, but we are required to document that discussion with the audit committee on the risk due to fraud. And also look at the quality of minutes and documentation of discussion. So I think it's important that when you have the client meetings documented, also have appropriate internal documentation along with your EQCR of addressing the risk of material misstatement. all in all, what is expected is that risks of material misstatement have been done with appropriate analysis, appropriate consultation with internal auditors, appropriate analytical procedures. You have appropriate audit procedures performed on that. You have documented this discussion with the audit committee and the board and the management, and you've discussed the EQCR. So this you can safely conclude that your risk of material misstatement on a given area was done appropriately. And if I were to now move to the other areas and external confirmations, I think this findings have come from the QRB report, which says that confirmation should be obtained for all parties. So there was a case where at times RPT confirmations are not obtained. Every party is important. It's the auditor's judgment in terms of assessing risk and not management's prerogative. So, you need to also understand that, we have our own independence to do the audit procedure of getting confirmations. So control should be maintained over external confirmation requests, and also have appropriate data that the confirmation comes directly to you. This is a key audit procedure, as I mentioned. If management suggests that we should not circulate a specific party, we should understand the reasons and evaluate the implications of the management refusal on such risk of material misstatement. I think it's important that we cannot go with management's refusal only. Say, for example, the company is fighting a legal case with the creditor, and they say, don't send this confirmation to this creditor. We can evaluate that and say, okay, we'll not send it to the creditor, but we need to have appropriate procedures performed alternatively to be able to get comfortable with the creditor balance. So it's important that we just don't get guided by management's request, but understand the situation and do other work, which is important. Going concern, I think, again, important area of judgment, future looking. And this is where I think Nilesh touched upon of the risk of hindsight, right? So come May, everything is okay. And in the August, there's a loan default happening. In September, the credit ratings go wrong and the company has become a going concern. So when you sign the accounts in May, what is the situation at that date? And at the same time, did you look at the next 12 months from that date? So I think understand the key ratios over the past years to identify the trends, inquire with management whether they need to go to the GC and form your own assessment. I think when we're looking at inspection results, inspection reports, this is what is coming out at times that the auditors didn't do even the basic assessment of going concern. So obtain management assessment of GC with future cash flow projections for at least 12 months approved by the board. If management refuses to provide the assessment, and this is there in SA 570, you need to discuss with those charged governments, with the audit committee and the board, and also assess reporting implications. Discuss challenge management assessment of going concern, and minutes of the discussion should contain management's view and auditor's assessment. So as we spoke about ROMM, out here also, you need to document the management assumptions of going concern and minute that discussion. Assumptions that cannot be audited should be benchmarked to industry trends. In case you get a letter of support from the parent company, look at the ability and intention of the provider of the letter of support. Management representation should be conclusive and preferably detailed to cover all assumptions, and also look at subsequent events which happen after the board meeting date, after the year-end date. Look at the cash flow statement, and also don't be over-reliant on the board's assessment over here. Our responsibility is to have evidence on our file of the work which we do. Getting the board's analysis and keeping on file is not good enough. We should read that, but we should also communicate with the audit committee and board and document our own assessment over here. And we have to have work papers to support all of these procedures which we do. So your documentation again becomes critical over here. Internal control of financial reporting, there's an appropriate ICI guidance note. I will not take too much time on that, but in inspections, one of the key things which is coming out is that the documentation, again, doesn't support all the work which is required to issue a clean opinion, if you're giving a clean opinion. So, you're also always required to have appropriate documentation of controls around management. And if you're looking at a fraud risk, then how it address the risk of management override. You should also ensure that nothing is there in your work which contradicts the internal audit report. Because many times you'll say, I have a clean ICFR, but there's an internal audit report with issues over there. You need to ensure that there's no gap of that. And yeah, so I think in ICFR, while the focus should be on high risk areas, it's also important that also ensure low risk areas don't have any issue like testing of controls. Coming to subsequent events, very important. After the date of balance sheet, please be alert. Look at market news, look at information which is there in the public domain, look at company's MIS, look at board minutes, make inquiries with management, be alert to see any changes happening after the balance sheet date, because that may impact your opinion. Classic example, as I mentioned to you, was a going concern issue. For example, till March, everything is okay. You're signing in the month of May, but in the month of April, suppose there's a debt default. Now, the debt default in the month of April, and you're signing in the month of May, your going concern will get impacted because you have to look at going concern 12 months after the balance sheet date. So it's important always be having a close watch on such events. I think this is something which regulators are quite conscious about. A management representation does not take away the auditor's responsibility. So management representation letter does not affect the nature, extent, or timing of procedures to perform. It's not a substitute for audit work. You have to ensure that there are no inconsistencies in the representation letter and the evidence obtained which are there in your file. I think also ensure that the management letter is issued on the same date as the audit report. I think these are some things which came in the inspection which NFRA did. This is the third pillar of quality control. I think compliance and ethical requirements is more to do with the code of ethics and independence. Very, very critical. Every audit firm and every audit engagement needs to demonstrate that. So all team members should be compliant with the independence. They should not be having any financial interest in that audit client. They should not have any relatives working in the audit client, and there are rules around this. Acceptance and continuance of client relations and audit engagements. It's important to have that documented as a part of the quality control system. Assignment of engagement teams. So generally, if you're looking at a high-risk client, you'll put a more experienced team. A company which is not high-risk may have a younger team or a newer team. Engagement performance, you need to have appropriate controls as a firm or as a partner over the direction, supervision, and performance. There should be appropriate reviews. There should be consultations. And I mentioned to you about consultations outside the firm. Ensure that you are complying with the code of ethics. There should be appropriate EQCR if it's a listed company, or if it's a large complex audit client which is not a listed company. And if there are any differences of opinion in consultation, they should be appropriately documented. You also need to have appropriate monitoring and documentation of all the aspects of quality control. For engagement partner, I think it's important. Again, this is coming more from our experience. Regulators are expecting, or inspectors are expecting, the engagement partner to have appropriate discipline for timely planning, supervision, and review. And this should be all documented. It cannot be just that I did this. There should be evidence on file. Plan the engagement and budget adequate, have appropriate time for that, and there should be evidence of time spent. For the EQCR, same. There should be documentary evidence that the EQCR happened. Put minutes of meeting on record, audit conclusion memo on record. Appropriate communication channels, having emails or review comments is important to show. Again, this is one of the important aspects which came about when it comes to NFRA inspection based on our recent experience. Communicate, those are governance. I think Nilesh had touched upon this. This is a very, I would say, a new topic which came about after the first NFRA inspection. So typically, as auditors, we engage with audit committee in a listed company. We don't meet the board because the board has given the responsibility to the audit committee to manage the element of audit. So we meet the audit committee. The question is, is meeting audit committee adequate or not? So as per the auditing standards, it is, if it's a subgroup which is formed, then it's appropriate that auditors meet the subgroup, but that should be documented in the file. Why the board meeting of the board is not necessary. Agree the communication with and timing of with the audit committee. Hold meetings with them to discuss the audit plan and including risk or material misstatement. We spoke about this. Document the meeting. Presentations to those charged with governance audit committee should also include key procedures performed and judgments made by the audit team. For critical matters, document the management's assessment and what sufficient appropriate evidence has been obtained and how you reach the conclusion. And again, SA 260 defines the minimum communication. I will not discuss this because it's already there in the standard. But it's important that we get the response from those charged with governance and document the response in our files. What are the key takeaways? So I think I'll just take a pause. I think what I've done is that what I've discussed with you was the key observations coming from the inspections. What I'm going to do now in this slide is just what are the key takeaways for each of us over here. Again, this is not a complete list, but it's important that we reflect on these points as we go back to audit execution. First and foremost, it's to do with compliance with all components of SQC1, compliance with all mandatory standards on auditing, accounting, and code of ethics and ICI guidance. One of the key expectations of NFRA was that if you are saying you're following Indian auditing standards, then tell us how was this para of the standard applied. Nilesh touched upon this as an example that, This may not be possible to do in each and every work paper in each and every area. However, if in principle we followed the auditing standard, and the ICA is also taking steps to develop audit standard checklists, so please watch that space. If the audit standard checklist is available to you, you see that the checklist was complied with the appropriate work paper reference, that should support compliance with the auditing standards. But this is a very tricky area, and we are requesting ICI to share some guidance on this, at least for practitioners, so that they don't get caught on the wrong side. Communication with management and those types of governance on a timely basis. Again, that's a critical takeaway. Talent, competency, and training. I think we didn't touch upon this because it's a very important element of SQC1. But if we look at our business is, as I said, only on how strong and good our people are. So sharing of knowledge, sharing of experience, and their training is very critical to doing a good quality audit. So we had to invest time in this. Challenge management and demonstrate skepticism. I think client interest and public interest, the same phrase comes over here. Client interest comes first, but we cannot disregard public interest. So public interest comes second, but it's more overarching. So it's important that we challenge management and also demonstrate skepticism in our documentation. Appropriate partner and EQCR involvement should be there on file. Perform work, then obtain management representation. MR should not be the only response for significant matters. We touched upon this. Consultation, use collective and professional experience and knowledge. Independence should be in substance and form, and communication within the firm and engagement teams. I have kept these 2 bullet points over here towards the end. It's the 2 ICI resources. I found them to be extremely useful. So, we spoke about audit documentation, and there are a lot of documentation tools available in the market. But as far as this topic of this presentation we discussed today, these are 2 ICI resources, which is a Committee of Capacity Building for Members in Practice, the CCBMP, has issued a booklet, the e-booklet on sample checklist on essays. So it will be a good way to get started with the compliance with the standards on auditing. And also there's the ICI AASB guide, a practitioner's guide for audit of small entities. So these 2 publications are available on the ICI website. I will strongly encourage all of you to refer to these and use these to see how you can build your audit documentation file. So with this, I know this was a 2-hour meeting and we have to do some Q&A. So with this, I'll probably take a pause over here. I'll also now, invite questions from the audience.
So Govind, one question was on SVB Bank. How do you see, auditors' role or the responsibility casted again on auditors? So what's your view on that?
Yeah, so SVB, I think, it's of interest to all of us. So, we are also trying to see what happens to the auditors over there. But see, SVB is a case of a corporate failure in the US market. And there are also a lot of other regulatory checks which are being done as we speak. Because, it's not that unlike India, where you go straight after the auditor, more in the current times. But I think there they take a structured approach. But clearly on SVB, there will be a question which will be coming onto the auditors because, as I explained to you, the concept of going concern, right? The going concern risk and the risk of, the company tiding over the next 12 months is very critical to our audit opinion. So I would expect that stress to come. As of now, we haven't seen anything in the public domain. But I think, as I said, in the US, it goes more structured. We'll go first after the company, after the board, after the understanding how the rating agencies did the work, how do the regulators saw the risk, and they also go to the auditors.
Yeah, Rajesh Moody has one question. Sure. What is the main reason for the auditors are not able to identify the red flags on time?
Again, I'm just sharing my feedback as this question has come. Again, all of us can answer, but from my own experience, it actually comes from the fact that has there been appropriate attention being given to the issues? Have we exercised that professional skepticism? So what happens is that, because of this whole concept of watchdog and blah, 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 we almost think that we are only watchdogs. We are not only watchdogs. We also have to be alert to issues. So in my view, we do, in my own experience, in my own audit clients, I always keep a watch for red flags. I don't go looking for red flags, but if I have to be alert to be able to identify the red flags. So I would say it's always possible to do the red flags early in the process. However, if it's a well-designed management fraud, then it may not be very easy. So you have to, that's why we say that we're not here to do the fraud investigation, we're here to do the audit. So I will also give that benefit of doubt to us as chartered accountants, as practitioners, that we have to be alert for red flags. At the same time, if it's well designed and well conceived, it may require additional effort to identify the red flag. But for example, if a company is having debt defaults, those are red flags. Maybe the debt defaults are very small, but they are red flags. But if I say the red flags are only in first quarter of the year and last 9 months was okay, then I can still be okay. But if the defaults have continued throughout the entire 12-month period, then I'm looking at going concern. I have to see it's a red flag, which is a different red flag. So I have to look at the red flag also, how bad the issue is based on judgment. And can I just add one more to that comment? I think Rajesh, to your question, and I think I'm again sharing with my own personal experience. I always find a lot of comfort, again, considering client confidentiality, to consult. As you'll appreciate, audit is a very professional, opinion-based, personal opinion-based business. So Rajesh, if you see a red flag, that red flag may not be a red flag. But if you consult with somebody else as a professional without keeping the professional confidence, taking care of the code of ethics, then you may get a better answer. Maybe you get guidance to address a red flag, or it may not be a red flag also. So I'm just giving the perspective that, for me, if I have a problem, I can walk up to Hemal and ask Hemal a question. Hemal, how does this work in your? So he gives me his point of view. So I think it's easy for me to then, okay, I get two chartered accountants with 10 years plus experience discussing that topic, right? So it becomes easy to address the issue. So I think I would also suggest two consultations.
Yeah, Govindji, just I had one question mainly related to related party transactions. So based on your interaction with the regulators, how an auditor should approach a related party transaction, especially in the light, I think from 1st April 23, there is an amendment in a SEBI LODR related to purpose and effect of an RPT, where if let's say holding companies doing with an unrelated party and subsidiary, but the benefit ultimately flows to a related party, how should an auditor, in the light of also what is happening so far in the related party space and the current case which has been matter under sub judice, how should an auditor approach a related party transaction and document it well to safeguard himself?
Yeah, I think Tejas, I'll answer this question in 3 parts. One is the quality of the client, the quality of the corporate. 2 is the governance in the corporate. 3 is the audit work I'll do. So I'll answer the 3rd question because that's what you asked me the question, right? So I think if the first 2 are good, I have a good client and good governance, and the audit committee and the board are doing the right steps. I think as an auditor, I will only follow what is there in our CARO guidance and auditing standards guidance on RPT, right? Of understanding the transaction, is the party genuine? I think we have to ask a few more leading questions to comply with the new SEBI regulations which are applicable from April 23. But some of them are also applicable from April 22, right? So question was that, if a subsidiary is doing a transaction with the RPT, which is a group company, but not part of the same audit group, you have to ask those questions. So I think we have to do the same process with some more questions and a lot more documentation. But very importantly, we have to also ask the right questions to the management and to those other governments. So the way I did my audit was, I took those questions to the audit committee chair, and I asked the question to the audit committee chair that this is change in SEBI. This party is not there. They want to reevaluate that. So the audit committee chair heard me out and he said, okay, what evaluating? Then they evaluated this internally, and the next audit committee, they came and said, yes, this is the RPT. So it's a question of having the dialogue, right? After you see that, you go and have a dialogue with the party.
So there is one interesting question from Vishal Shah. He's asking.
I saw that. If you have a very broad view of the entire audit exercise, doesn't it appear that due to increase in number and complexity of accounting and auditing standards, auditors' time is more spent on complying with the standards and audit, and substance has been lost? So Vishal, I'd like to respond to it in a different manner. When NFRA and the PCOB and when the new way of looking at the files is coming up, they are looking at it that the file is only good in form. So they are exactly echoing what you are saying in your statement. However, this is where we as practitioners have to rise above and ensure that substance is not lost. So, I may have a very good audit file, but, if I know that this company is having a huge issue to do with the recovery of the debtors, or they have a huge issue with debt compliance, So if I'm aware of that, and I say, no, let me get the work paper, let me get the file right, but there could be a default in 6 months' time. That may create a problem for us. So we have to not lose substance. This is where, the matters of significant judgment, the consultations, they come into play. So I completely appreciate your point. At times I also feel that it's becoming a check the box exercise. Checklist, tick, 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 and put on a file. That is not going to help me comply with my professional responsibility. But if I do that, but while I'm putting the tick mark, if I see an issue over there, then I have to also understand the substance of the issue. So it's a very tricky one, Vishal. It's easier said than done. But we have to now start looking at substance more than form. NFRA and others are challenging form today. So ICAI and others, when they see the work paper file, they see everything is proper. But there's a default 6 months down the line. So was there an issue with hindsight? Was there an issue with expectation? So I think it's more a question of experience coming through over here. But there's no right answer to this one. We'll have to keep ensuring that we don't lose sight of substance.
There are two questions from Rajesh Modi. One is, do you believe that existing standards are sufficient enough, but the problem is on the performance? There is a performance gap and there is a failure on the part of the auditor. So that is first question. And the second is, are we moving towards 100% coverage of population and use of analytical software, and sampling, which was earlier random sampling or testing of few, is think of the past now?
Yeah, I think first question is absolutely right. I think there's a performance gap. And performance gap, I'll tell you, Rajesh, the way it is looking at is that, the performance gap is coming because there's no evidence available on file. If you have the documentation on file, then at least your performance is demonstrated. So I think I would just go back to the gospel of documentation. The request is keep your documentation appropriate and your performance gap will come down. Of course, a partner, a senior professional with experience of the audit, like all of you on the call, if you spend time from the beginning identifying red flags, identifying judgments, documenting that work, that is also show the performance gap. And Mr. Sridharan's quote, if you had seen, he said that the performance gap will come down if the auditors do the job properly. So I would say that performance gap certainly is an issue, but a good documentation, good application of the time by a senior professional will help us address the performance gap. Coming to sampling, I think we are way past coverage. Coverage is a thing of the past. I'll tell you why. With today's technology, and again, I'm not talking about necessarily large firms or having audit tools, even if it's a simple Excel sheet, a smart data extraction and a smart analysis of the outliers can help you focus on the key issues. So my urge to you is that don't move away from coverage, do risk-based. At the same time, your data analytics, be it even an Excel tool or be it pivots, be it macros, can help you identify the outliers and do a more smarter sampling or sharper sampling than you would normally do. But coverage is a thing of the past. I think we can only do coverage where it's very simple, it's like rent income, right? You have area into rate. You can do that. But that's not the only business we do. We do so many other businesses where it's very difficult to do that 100% audit. So coverage is a thing of the past. Smart sampling is the way forward. Use data analytics, use Excel, and Excel is very powerful. We ourselves do it. Last 7 years we've been doing it now. To identify an outlier doesn't take too much time. After 2-3 times of experience, you can master the entire process to do it. So yes, we have to get to a sharper audit. I hope I answered Rajesh's questions, right? Yeah, there were 2 questions from Rajesh. No?
Yeah. So though we have exceeded time, going just 2 questions from Percy Irani.
Sure.
So one is, for a loss-making company, ideally, how is the performance materiality computed?
Sure.
And the second is, for a loss-making company which is not asset-heavy, how is the overall materiality computed?
Sure. So, Percy, when you look at a loss-making company, we generally look at, I'll have to go back to the theory part of it for 2 minutes. What is important to the users, right? So if it's a loss-making company, then is the company incurring losses because it's a startup or because it's going through a bad economic cycle? Is it a full-fledged company loss-making only in the last 2 years? Are there history of operating losses? After looking at all those trends, I could also go to a measure of revenue if it is not necessarily an asset-heavy company. I can also go to total assets. So it's a question of what is important to the user. So suppose that the company is using working capital financing, right? And their working capital financing is based on debtors and inventory. Then I would also like to understand, is that current assets becoming a basis? But generally we don't go there. We generally go to profit before tax, or we go to total assets, or we go to revenues. Generally, rarely we go to gross margin and EBITDA. But these are the 3-4 measures you can look at. You can go to revenue as well, if it's a full-blown operating company. If it's a very company which is a startup and no revenue and only losses, you can also look at total expenses then. But it depends on each fact pattern. But whatever you choose, it should be based on appropriate user selection and appropriate documentation. I think the gospel is documentation. Even if you choose any measure, if you have a good enough reason why you chose that measure, it should be good to support your decision.